Hello. In the previous video, we have learned until the expenses. So we have modeled the customer acquisition, we have modeled the revenue, we have modeled the pricing, and also the expenses. In expenses, we model the cost of sales, we model the staff payroll expenses, labor cost. Based on the productivity and the standards, we measure the operating cost and we measure the marketing expense. Now we're gonna look at the capex. So in the past, we had discussed that we need to do the capex based on the capacity, right? So in the previous model, we looked at two, three different type of machines which have different ability to generate the coffee and different ability to make the sandwich or a toaster. And then we say, okay, how many of them do we need based on the production? So here again, we follow the same principle. So the total number of customers actually despise the total number of orders, because we are assuming everybody would offer only one coffee or one tea or both of them. So it when you have more of such customers, you may want to look at the separate you will have to relook at the assessment. So the total number of customers, as we have seen, is this. So we can link it with this, and the month, year 2, year 3, year 4, year 5. Let's look at the format of the cell so that we proper. Okay, great. And we can look at the make it fixed that it does not. Now total customers. So based on this customer, we need to have machines. So first we need to identify what are our capital investments in the beginning, or whenever we need to invest more into the business machines. So there will be definitely a coffee machine because we are selling a coffee. There may be requirement for a grinder. There may be a requirement for a toaster. There may be a requirement for a fryer or a gas or kitchen equipment, maybe or a oven, or you may need other cutleries, right? So other cutleries may be needed in the business based on the business. So let's say if how we are going to design how many coffee machines do we need. So it would depend on how many coffees we can serve. So since this is per month, we may need to divide it by 30 per day, and we may also look at per hour. So per day is going to be, let's say, divided by 30. Per hour is going to be, let's say, the free time, the average, on an average, the restaurant is going to be busy only for 6 hours, even though it may operate for full day. So not every time the customer will be coming to the restaurant. Then you know that how many customers we would need to serve on an hourly basis. If let's say the coffee machine has a capacity, so it depends on the capacity, right? So now you can see per hour is 12 to 15 to 16 to 20, and then it goes up to the in the another years. Sorry, this is again problem. So divide by 12, so you get it. So in the maximum you would need in year 3 is going to be 30 30 30 covers 30 to 35 customers, 30 to 35 machines. Now you may have different choices because you are going from 12 per hour to 35 per hour in 5 years. So you may, because in the coffee machine normally is life is 4 to 5 years or 10 years sometimes. So it depends on what kind of different models are available in the market. It's giving you a choice to have how many kind of machines you want. You can buy a machine which can serve up to 20 cups an hour, so that it meets your requirement for year 1, for first 6 months to save the money in the initial time so that your interest expense is lower. So you may have to build the model, right? So maybe you have a different choices here. So maybe one coffee machine is model one, which is serving maybe model two, or maybe you want to serve, okay, uh, you have to have a choice, right? So depending on the capital budget, so you may want to buy a model which is can serve only 15 for first few months, and then another 15 for when you have later on you have a growth, so that it can easily serve up to 3 years. So you have to plan that, or you can buy 20 now and then 20 maybe at the end of at the end of second year, so it will serve you for another 3 4 years. So you have to make adjustment, and then it's easier, but you cannot just say in the beginning, at the moment now I'm going to put 12, so I will just buy that machine which can serve only 12. So this is how you can make the capex decisions coming out of models which are predictive, and you can see how much we are going to need. So this way it's easier. So and on average, first year is 16, second year is 22, third year 30, and then 35, right? So but in if you go into the detail by month, you can see it's starting from 12 and going until 22. So if you look at only year average, it's only 16. But when you look at by month, then you know actually is you may need up to 20 and 21 as well. So maybe you want to buy a machine which can serve you up to 20 peoples, right? So let's say that that machine cost $3,000, or maybe $30,000. A very costly machine, but we are just taking a hypothetical figure here for the time being. Oh, sorry, you don't need a machine every hour, every month. So then 30 hours, and then you will need another machine only in the since this is up to 20 cups, right? You can say, okay, now in the next app I will need a machine only in this month, right? So another 30,000 I would need to spend in year in the November, and then another 30,000 I would need to spend. So this is 40 cups. So this is not. So this will fit our requirements until year 5. I don't have to spend anything more. Uh, or alternatively, you can say there is a model 2 which can serve up to 15 cups, and then that cost is only 20,000. So you don't get, then you up to 15 you need here, and then you need another 20,000 here, and that will become to 30 cups, and then you need another machine in this year, right, at the end of this year, so that you have you are able to serve on an average the cover. So you are spending 60,000 but not immediately. So is the different, the cash flow is different. So if since you are going to borrow the money, you have to see what is the impact. Since you can evaluate two different cash flows and two different P&Ls from here, and you can have a separate assessment of how you're going to spend. For that, you need similar way you can do for grinder, you can do for toaster, event, and cutleries, so that you can understand how much capital requirement you need and what would be the impact on the profit and loss statement. Let's look at only one option for the time being, then you can just replicate into two, so it's easier for you. So for the time being we take this one, which is easier. Then let's say the grinder gonna cost you $5,000 extra with the coffee machine, because you need one grinder for one coffee. You will need toaster. Maybe let's say the toaster can serve only 10 per hour, right? Or maybe 20 per hour. Again, the toaster will cost you, let's say, $2,000. So you need one now, if 20 per hour, and then one another here or maybe you say the toaster is only 10 per hour maximum, right? So means that you need two at the moment. So 20,000 into two, and you need another here, right? So that you can be able to serve another. Uh, extra customer from, you need one only at least, because it's only 10. And then you will need one more, that becomes the fourth, so that you are able to cover up to year 5. Then you may need oven. Oven is maybe also cost $2,000, and then you need only one. Okay, enough. Or may need another one here based on the following the toaster, and another one. Cutleries would depend on how much you are going, because we have to serve the customers. So every customer, so how many sets you will need. So let's say it's um, you can wash every hours, but you need at least two, one for stock, one for replenishment. So means that into two, into one set is it's gonna cost you, let's say, $20, right? So that's the type, that's the initial investment you need. And then for every increase in the customer, you will need to increase it. So you can say, any increase, how much is the increase? This is the increase in the customers. Oops. You can round off the increase so that it's round, and multiply by 2, multiply by 20, and then you will be able to understand how the my additional cost is be, right? This is how much you need as an extra money, right? So in the year 1, you will need this money, and then year 2 onwards you will need this much. So this is your capital investment. So that makes it easier. So the income statement, when you go to the income statement, now the depreciation you can calculate here. So the total investment, assuming every one of them has similar life, which is uh, 5 years. So since depreciation we are using for a year, sorry, for 1 year, so the it's 80,000. So you can use it by month as well. So now depreciation you can link. The depreciation will be, if you follow the straight line method, this divide by 60 months, correct? That is going to be your monthly depreciation. And then next month, next year, next month, next week, sorry, next month depreciation will be the same formula plus the previous month depreciation. So that will continue, right? Since we are doing until 5 years only, so we can follow this. Sorry, this is for the whole year, and then we are just follow this, correct? Yeah. So 1307, and then this is gonna be 12 months. So it's not going to be divided by 20 anymore. It's going to be divided by the sum of it, and then you will be using, yeah, correct. That's you will be this, because this is for whole year. You're gonna divide by 12. Is it will be wrong? Yes, right. That's the depreciation. So now you have almost everything. So let's link the numbers, and then we will get our P&L. So the revenue, since we have followed the same structure of the columns, we can just link one and copy the others. You don't need to link it one by one. And you have cost of sales in the expenses. Cost of sales is this much. We will beautify this later. Gross profit is going to be this much. Then you have other operating expenses, which are going to be your labor cost plus your operating cost, or you can make it separately. That's fine as well. So let's say you have a separate labor cost. right? So you don't need to merge them together. Oops. Right. And then you have EBITDA. So EBITDA will be gross profit minus labor minus operating cost. That you can, to make it easier, you can say total other operating cost. And make it sum, then you can divide the total operating cost. Let's do that. This is our profit and loss statement. Depreciation we have already discussed. Uh, Here is your depreciation. So we can copy this and till the end. See, once you are having a similar setup, then it's not very difficult and it's super fast to do the models. Interest. We have not calculated interest, but now we can calculate it. So let's say now the total investment, you have an initial investment here, initial investment of $10,000. So your total investment is 40,000 here, right? So how much loan you need? Loan required. This minus, oh sorry, this minus this, right? So means you have to pay the interest on this amount. So let's say on a round off, you take $32,000 or $35,000 because you need to have some initial capital. So your total investment is 35,000. So you need to pay interest. So let's say you are paying around 0.25% in a year, in a month, right? So this will continue. The question is, do you need any further money here? You can say that my cash flow has been generating. So my total income, my EBITDA has been about 19,000 in year one, which I think you cannot is not enough to cover the investments here. So let's take the loan first. So how much loan we need? So now you can say I am needing in more around more money here, so I have to borrow another this 4,000. Maybe you will be able to survive from your cash flow, so you need another 35,000 this month, and then there should be enough because the rest of the money you can pay from your pocket. So this is the really the investment that you need. So the monthly interest will be this plus previous one, right? This is the monthly interest, like we did the formula. Yes, that's increased. So year one is this much, and then the year two is going to be the same formula, right? Because we continue to pay, and then year five. Now we will plan when we are doing the cash flow, how can we refund anything or not. Let's do that once we finish this one. So now the interest part, you have interest as well. So let's make it interest. Put the interest into the bottom line, copy this. Now the profit before tax is EBITDA minus depreciation minus that. Okay, and then now we calculate the tax. Let's assume the tax is 25%. So sorry, 25%. So we can fix it. Uh, hmm, yes, and this minus this. So this is your little income that you have every month. But at the end of the year, you will see it's quite a lot. Right. This is our income. So here again, it's a little bit of hodgepodge. So we can increase the column some size here so that we can get and also do bold so that it's the beautification, slightly beautification, so that we know what are the key figures. Right. Now here we know what money we are going to make in each year. Okay, some of the months we are not able to make much money, never mind. So now you need to do a cash flow. So when you are doing the cash flow, you can follow the cash flow, very simple. So revenue, maybe the gross profit earned. So we are following the indirect method, net profit plus depreciation, right? Initial capital. This is operating activities, operating cash flow, investing, and financing. Okay, so means investing means capex, how much we are money, and then loan taken and loan refund, right? So let's fill this up because we have things ready. We can just make it quick. This is going to be the year 5 done. So investment activities, net profit is linked here, so we can link it up. Depreciation, we can link it up. So the total cash operating cash flow will be this plus this. We are assuming we are selling and buying everything at cash basis. You can definitely build up the model with a credit, means maybe 30-day credit or a 40-day credit. That's easy, so that you can forecast the balance sheet that we will look at it in the next video, not now. Then you are spending capex. So the capex is here, our total investment. You need this money, okay, and then the finance taken. So you are taking the finance, sorry, the operating cash flow. Since this is an investment, so we should be doing it minus. Yes. So operating cash flow will be this much. Then you have loan taken will be plus. Oh, sorry, initial investment is going to be, oh, you have initial investment. You have initial investment. So we have captured in the initial investment, and also we have captured the uh, loan taken. Financing activities, sorry, we have to remove the financing activity from here. Add the add back interest paid, because interest paid is a financing activity, so we have to add it back as well. Interest. So your operating cash flow will be slightly higher, right? And the interest paid. So whatever you are going to pay, you have here, right? And then you will be doing a total of your operating cash activity, cash, this cash flow from investing, so from financing activities, net cash flow, right? Since you don't have opening balance, so you don't need that. Now operating cash flow, this plus this, so you have opening balance now, right? Net cash flows. So let's copy this formula as well until the end. Then we know how much we are spending. Are we negative any month? No, we are not negative any month. This is the total, so accumulated cash flow, cash balance is going to be this plus this. Year one is not like this, is going to be total 16,000, right? So then it will be the year. So that's the total already. And it will become the be minus. So now you can see you have some cash balance to return the money. So do we need really 35,000? Can we do and less? So we can change here how much money I need. So I can go and change it to 30,000. So your cash flow will change automatically. So now you have a cash balance of only 8,000, right? At the end of the at the end of year one, you are left with 16,000, because this is the total. Yeah, sorry, this is the total only. So let's fix that. Otherwise, we gonna be doing a wrong thing. Hmm. Yeah, now it's tally, correct? 10,400. So you have to make sure that it tallies. Now you have a cash balance at the end of second year, so you can model, will you be able to return some money? So yes, I can see we are able to return some money here. So we will go back and say in year one, I will return maybe 20,000. Let's see how the 20,000 will affect my cash flow. Oh, we haven't modeled it. That's why loan taken. Oops, oh, wrong, no, wrong. Okay. So the 20,000 is coming here. You can put it into one cell to make it easier for the time being, but I still have some money, so I may be able to return more. So I can say minus 30,000. And then you can see, do I have enough money more? I need to return another 35,000. So I have money here, can go and return another 35,000 unless I need money for further expansions, right? I have no more money left from the investors. I have done almost everything, 65,000 to 65,000. So now we don't need to pay any, right? So now we save money here. That's our cash flow for year one until year five. So this is how you can model your cash flow. In the next video, we're gonna model the balance sheet as well.